Hey guys, it's Hamish here, and today we're going to be talking about when you shouldn't buy the dip. So you'll often hear this thing, buy the dip. Your stock's down 20%, buy more. And it's kind of true, but not really. And I'm going to explain to you today when you should be buying the dip and when you shouldn't be buying the dip, and why you can just completely throw buy the dip out. You can just completely forget about that, and you can focus on something else that is going to make you a much better investor going over the long term. If you do enjoy the video, make sure you leave a like and let me know your thoughts on this video down in the comment section below. Both of those actions help me out a ton, but I hope you guys enjoy this one, and let's jump into it. So a common thing that you'll hear is that you just should always buy the dip. Whenever a stock that you're invested in falls a little bit, that you should buy more in order to average down your position. And this is the right idea. It's on the right track to getting it right, but it's just not quite there, and I'll explain what I mean by that. And the first thing is that when a stock is falling, if you're saying that you should buy the dip, you're implying that the market is wrong. That the value's up here, the stock price just fell, so you should buy some more down here because you're getting this in value. The problem with that is the first point is that the market's not always wrong. Sometimes when the price is falling, so is the value. And what I mean by value is essentially we calculate value as how much cash a business can bring into us. How much cash over the next 10 or 20 years are we going to get back from this stock in terms of dividends, in terms of stock buyback, and in terms of retained earnings and the value of the company growing. Now, it is true that sometimes when we're investing in stocks, their price will fall, but how much cash that business can provide for us over the next 10 or 20 years doesn't change. And in that case, yes, you would want to add some more. However, there are other circumstances where the price falls because the amount of cash that that company can provide for us over the next 10 or 20 years is also coming down, and you need to identify that. You can't just always buy more of your businesses. It might be a great business when you initially bought it, but maybe a year later, the stock price is falling because the value of that business is also falling. So that's just one point that I wanted to make. The next point is that sometimes stocks fall because they're overvalued. Again, which means that the market is right. If the price of a stock is here and the value of a stock is here and it falls a little bit, but the price is still above the value, you shouldn't be buying it. So it doesn't mean that you should always buy it just because the stock falls. Like, think of this. If a stock is 100% overvalued, so it's double the price that it should be, and then it falls 10%, some people might say, buy the dip, buy some more, average down your price. But if the value of the stock is down here and the price is here, you shouldn't be buying more. You should be selling it, or you should just be holding it. And you probably should be selling it, because if you're holding overvalued stocks, it means that you expect them to keep going up even though you know they shouldn't, because essentially a stock should hover around its value. So if it's above its value, the logical conclusion is that over the long term, it's going to come back down to its value. So by holding onto that stock, you're just gambling that people are going to pay more, and people will be willing to pay an even more overvalued price. One example that I hear all the time, and I use this in a few of my videos, so sorry if you're an Amazon investor, but people saying Amazon just fell 15%. Quick, get in. It's on sale for 15% off. And that's not true. If it was on sale for 15% off, that implies that the original price that it was at before it fell was fair value. And I personally don't think that Amazon is anywhere near fair value. I think it is way overvalued for what it produces, or at least if it's not overvalued, the expectations of how much cash it can produce in the future are sky high, to the point at which I just don't feel confident that they can achieve that. Or I don't feel confident in making a bet that they can achieve that. I mean, at the time of recording this, they have a market cap of somewhere between 800 and 900 billion. So that's the price for the whole business. And they're producing free cash flow of 8 billion. So there's a long way away before this company is producing enough cash to justify the price tag that you're going to pay per share for this business. So the common theme between those two objections I have to always buying the dip is that you need to know what the value of the business is. The value matters. If it's overvalued and it falls a little bit, but it's still overvalued, then you shouldn't buy it. And that implies that you need to know what the value of the business is. And the other thing was that if the stock price falls, sometimes the value's falling with it. So that also implies that you need to be able to recalculate the value. So what do I mean by value and how do you calculate it? The first point is that you need to identify that the business behind the stock is a great business, that it's not some shoddy business that is really, really risky and that is got a high uncertainty of producing you cash over the long term. And we identify this in three major ways. The first is that the stock needs to be within your circle of competence. You need to be able to completely understand the businesses that you're investing in for a couple of reasons. So that you can identify problems. Like I said earlier, if the price is falling, you need to be able to identify if that's justified or if it's unjustified. And the other reason is that in order to calculate value, the intrinsic value of a company, you need to project into the future how much cash it's going to bring you. And your ability to estimate those future cash flows entirely depends on your knowledge of the business, the industry, and its competitors. The second thing you need to identify is that the businesses that you're investing in have a strong intrinsic characteristic that gives it a competitive advantage over the long term. We like to call this a wide economic moat. And this basically means that they have something intrinsic, some characteristic about their business, something that's unique to the business that is going to ensure that it continues to be a great company over the next 10 or 20 years. One of these economic moats is called a switching moat, and that means that it's difficult for you to switch away from a company's products to a competitor's products. And a prime example of this is Adobe and their Creative Cloud. We're talking about Photoshop, Premiere for video editing. All of this software is used by a lot of big businesses, and the employees that are using these softwares, they're trained to use those softwares. So if the company wanted to switch away to, say, Apple's video editing software or some other kind of video or photo editing software, it would cost them a lot of money in order to retrain all those employees to use the different software. So that means that Adobe has a lot of customers locked down to their products because it's just a big cost to change. And that's a switching mode. And that means that a lot of customers are going to stay, and it means they have a huge advantage over other companies in that industry. And the third thing that you need to look out for is management competent? Is management doing a good job? You might have a great company, but if new management comes in and starts making really bad investment decisions, it's not going to be a good company for long. They're going to destroy your value. You need to make sure that in the past that management has been doing a good job, and in best case scenario, the management is going to be the same for the next 10 years. If management's constantly changing, it's really hard to work out whether or not they're going to be good for you over the next 10 years. And by good for you, I mean that of the money that they're investing, they're making good investments, that they're turning $1 into $1.50 or $1 into $1.30. You don't want a company that's turning $1 into $1.01 because it's going to take you way too long to compound your wealth over the long term. And you can't expect the business or the stock price to grow if the business internally isn't growing and if they aren't generating more and more cash on their investments. The other thing you want to look for is, are they managing their debt? They might be getting a great return, but how much debt are they assuming in order to get those returns? Because remember, debt is basically an amplifier. If you're getting good returns and you push more money into investments, you take on debt to shovel into investments, then it's going to amplify the results of the returns. But the opposite is also true. If they're getting bad returns on investment, then that debt is going to amplify that negativity. So you need to make sure that they have a manageable amount of debt, a small amount of debt. So if we go into a recession and interest rates rise and they can't refinance, that they're not going to get stuck, they're not going to go bankrupt. And you also need to make sure that they've got a history of paying down their debt consistently so that they're managing it effectively and that it's not going to come and ruin your investment. Because it can be a great business, but if they just take on too much debt and they mismanage that debt, it could destroy the entire business. And it's happened before. So that's the two things that you want to look out for management. And the second thing that you need to do is you need to calculate how much it's worth. What is the value of this company relative to the price? Am I going to be paying too much? And of course, you don't want to overpay. You don't want to pay more than the value. And the value is, as I said before, how much cash the business can bring in for you. So you don't want to pay more than how much cash you're going to get back. And you certainly don't want to pay just under the value either. You want to allow a big margin of safety so that you're guaranteed to make the return that you expect to make, even if circumstance changes, even if they don't perform as they have, and if you misunderstood the business and you poorly calculated how much cash that business can provide for you. And then of course you need to be able to recalculate that value if circumstances change. So this is why you need to understand the businesses. It's why you can't just follow blindly someone else's investments, because it might be a good investment at the time, but if circumstances within the business change, or within the industry, or within the competition change, if you don't understand the business, you're not going to be able to recalculate value and work out whether or not that's a business you want to stay invested in. And the next point I want to make is that you shouldn't always invest more just because the price falls. So even if it's undervalued, you're very confident that it's undervalued, and then it falls another 5%, you shouldn't always add more. And the reason for this is that you're going to run out of cash. So what you should do is, when you're calculating intrinsic value, because we can't be exact, we're never going to get the exact value, because there really isn't an exact value until we know what those cash flows are going to be. So you want to make a range of values in which the intrinsic value will fall between. And you only want to max out your position when it gets to the very conservative low end of that range of intrinsic value. So you'll have a conservative range, so from maybe 50% of fair value, and then all the way down to a point at which they are 125% going to hit that, like 3% growth of a company that's growing at 15%, something like that. You would only want to max out your position when it reaches that really low point. And at that point, you're just going, I'm all in for this stock. I'm putting 20% of my portfolio in this stock, because even if they grow really, really slow, I'm going to make a killing in this stock. That's the only point at which you want to max it out. You don't want to max it out after it's fallen 10%. That's not enough. And often you want to be maxing out your position over quite a long period of time. And the last point I want to make is, just don't leave your return up to chance. What a lot of people do is they look into a business, they find a really great business and they're good at that aspect, but they never calculate the intrinsic value. So they're just guessing. They don't know what return they're going to get, because they don't know how much cash that business is going to provide for them. They're just buying it because it's a good business and it's falling. And they're guessing. They haven't even tried to work out where the stock price will be in 10 years or how much cash they can bring in over that 10-year period. Don't leave it up to chance. Just calculate it. It's not that hard. If you understand the business and you can sort of get a conservative growth rate of how they can grow their cash in the future, and you know how the industry is going to move in the future, if you understand it thoroughly, then it's not that hard to calculate exactly how much, well, not exactly, but you can calculate a range of how much cash they're likely to produce, and therefore you work out what return you're likely going to make on that stock. Don't leave it up to chance. Calculate intrinsic value. And if you want to learn how to calculate intrinsic value, I have a number of videos on my channel talking about Warren Buffett's method, a couple of Phil Towns' methods. We talk about owner's earnings, margin of safety. There's a bunch of different methods that are all pretty similar, and that you can use all of them to get a range. And I talk about all of them on my channel, so go check those videos out if you're interested. But I hope you guys found this video interesting. I just thought it was a topic that I wanted to cover, because I see sort of people talking about stocks falling and how they're now a buy or they're 20% on sale. And I thought I'd just want to expand on that topic and sort of talk about why it really just comes down to value. How much is a company worth? And how much are you willing to pay for that? So if you did enjoy the video, make sure you leave a like and let me know your thoughts on this down in the comment section below. But I hope you guys have a great day, and I'll see you in the next one.